Hello, welcome to this episode of Rich Insights. I'm Don Rich, the Chief of Investments or the CIO of Esoterica Capital Management. Today's topic is positioning. All right, we have equities at all-time highs, and I want to see how extreme the positioning is to give me some ideas how many people are chasing this rally. And so let's immediately go to the charts here. So what we're looking at here is a metric from the futures market, right, on speculative positioning. This has to do with the S&P 500. This is actually a futures contract on what's called the VIX, or it's a volatility. The volatility of the S&P 500. All right, and so when this blue line is high, it shows us, again over here to the side, that the market thinks volatility is going to decline. It's going to stay the same or decline. All right? That's when people are long risk-seeking assets. All right? I like this metric. It's one of my favorites because it comes out weekly. So it's a very real-time metric to tell us where we're at. Now, we just experienced an all-time high in this indicator back in December of last year. In December 2019, we hit an all-time high. All right, and you can see where we're at today. That black dotted line just helps us see where we're at today and how it compares to history. So back in December, we hit this all-time high, and then of course you'll remember in January, particularly at the end of January, we had the pullback in equities. Right, risk-taking had just gotten to be so extreme. Right, the investors were so complacent. There was such a lack of fear in the marketplace that things had really gotten stupid. Right, there's no more sophisticated way to say that than things had gotten nuts. So we're not at that level. We're not at the December level today, but we are still quite high. As we look back across the last 10 years, you can see that we are still quite stretched based on this metric. In other words, this data tells me that there's a lot of people that are still believing in this rally. They're still chasing this rally. Right? Now, as a professional money manager, I always think the first rule to investing is wealth preservation. Right? If you want to think about wealth building, the first step is wealth preservation. So, as a professional manager, the more reinforcing signals that I see, the more confidence I have in the environment we're in today. Right? So I spend the majority of my time, again, just trying to assess the environment we're in today. I call it the regime. What sort of regime are we in today? And so I look across a number of different metrics, different markets, different asset classes, to see how many reinforcing signals I can see. Now, these could all be negative reinforcing signals or positive reinforcing signals. But what we have right now is a complete inconsistency. I guess that's the best word for it. A complete inconsistency between the markets. All right. So on the one hand, we got equities at all-time highs. We got positioning still quite extreme. Right. Still quite extreme. Now on the other hand, we have gold. Right. Gold is a safe haven asset. Gold is up over 10% on the year. Right. It's up nearly 13% actually. We're only 2 months in the year. It's already up 13%. We got equities rallying alongside gold. Oh my gosh. That doesn't happen often. That should raise your eyebrows. What the hell's going on here? Right? But gold's not the only thing. Right? We look to the currency markets and we've also seen a big dollar rally so far this year. We've talked about that in earlier segments. To me, that's the story of the year so far. The strength of the dollar. Well, what does that tell us? Well, the dollar is generally considered a safe haven asset like gold. Right? So foreign investors are buying U.S. equities. They're buying U.S. bonds, right? They're buying these U.S. assets because the U.S. is a safe haven. It's a safe place to hide. So you got people hiding in gold. You got people hiding, foreign investors hiding in the U.S. Now let's look at the U.S. bond market. Interest rates have fallen considerably since the start of the year. Well, that's not a good sign. That's not a good sign. Now, also, within fixed income, we have an inverted yield curve right now. Right? We haven't had that in you remember, it was a year and a half ago. The last time we had an inverted yield curve. But that's generally not a good sign. So we got these terribly inconsistent signals coming at us right now. Equities at all-time highs, positioning still fairly extreme. Gold says, be concerned. Currencies say, be concerned. The bond market says, to be concerned. But equity says, the equity market says the party's going to continue. So what do we do with this? Right? This is always a tough environment when you get these conflicting signals. Well, I think, the first takeaway from this, right? The first investment takeaway is that if you're not in the ball game today, right? If you don't have an equity position today, stay on the sidelines. You'll get a better entry point. This is not a rally I would chase at this point. Now, if you are in equities, right? If you are in the ball game, you've got to decide between these conflicting signals and just how concerned you are about the inconsistency of these signals, right? But the message for today really is if you're not in the ball game at this point, I'm highly confident that you're going to get better entry points if you just hold off here for a little bit. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. This is February 21, 2020. I hope you enjoyed today's broadcast. We'll talk again soon. Thank you.